Welcome back, everyone. We intro the essay, depreciations methods in the previous the class. So in the next hours, we will intro about the liabilities and the shareholder equities. So first, liabilities. Liabilities are portable future sacrifice of economic benefits arising from the present obligations of the particulars entitled to transfer asset or provide the service to other entities in the future as a result of the past transaction or events. Liabilities is usually classified as either current or long-term liability. It's very similar like the assets. So we will intro the current liability as soon. Current liabilities are obligations whose liquidation is reasonable expected to require the use of existing current asset or the creation of the other current liability within a year or an operating cycle, whichever is longer. They include the following items: payable, unearned income, and the other current liability. Basically, three elements in the current liabilities. Payables. This is including short-term obligations credited by the acquisitions of the goods and the service, such as account payable for militaries or goods bought for the use or resale, wages payable, and tax payable. Payable may also be in the form of the written promissory notes and the notes payable. The unearned income. Payments collected in the advance of the performance of the service are termed unearned. They include rent income and subscriptions income rather than cash. A future service or good is due to the customer. This table displays other current liabilities reported by Accounting Trend and Technology in 2010. So you can find many other current obligations required payment during the year, and also you can find some company have the some items of the other current liability, but something not. So, however, it's showing all of as I know, but not every company have the items of the other current liabilities. Long-term liabilities are those due in the period as preceding 1 year or one operating cycle, whichever is longer. Long-term liabilities are generally of two types. Is financial agreement and asset. The other one is the operational obligations. These two types we will introduce later. The long-term liability that the financial agreements of the AC usually require systematic payment of the principal and the interest. They include the note, payables, bonds, payable, and the credit agreement. So it's just easy to understand, right? Notes payable, promissory note due in period greater than 1 year or one operating cycle, whichever is longer, are classified as long-term if secured by the claim against the real property, they are calling mortgage note. Bonds payable. A bond is a debt security normally issued with the 1,000 par per bond and normally requiring seminal interest payment based on the coupon rate. Bonds payable is similar to notes payable. Bonds payable are usually for longer duration than the note payable. Bonds are not necessarily sold at par. They are sold at a premium if the starting rate of interest exceeded the market rate, and they are sold at a discount if the stated rate of interest is less than the market rate. If sold for more than par, a premium on bonds payable arises and increases bonds payable to obtain the current carrying value. Similarly, if sold at less than par, the discount on bonds payable arising and decreases bonds payable on the balance sheet. Each of these discount or premium will be gradually write off amortized over the expected life of the bond. At the maturity date, the carrying value of bonds payable will equal the par value. Amortizations of bond discounts increasing the amount of interest. The amortization of the bond premium reduce it. So this is the example for the premiums part discount of this part. And if you have the textbook, Exhibit 313 illustrates bonds sold at par, premium, and discount. Yes, also, if you have the textbook, you can just watch it and compare with them. Bonds that are convertible into common stock at the option of the bondholder or creditors are exchanged for the specific number of the common share and the bondholder becomes a common stockholder. That's the definition of a convertible bond. Often, convertible bonds are issued when the interest rate on common stock price is low in management opening, and the firm even naturally want to increase its common equity. By issuing a convertible bond, the firm may get more for the bond because the option to convert to share then could be obtained by the issuing the bond legs in the conversion future. Also, the tax deductible interest paid on the convertible bond reduce the firm cost for this fund. If common stock had been issued, the dividend on the common stock would not be tax dedu- uh, ded- deductible. The common stock would not be tax deductible. Those firms may find that issuing a convertible bond can be an attractive means of the rising common equity fund in the long run. However, if the firm's stock price stays depressed after issuing the convertible bond, then the firm will have a convertible bond liability until the bond comes due. Credit agreement. Many firms arrange loan commitments from the bank or insurance company for the future loan. Often, the firm does not intend to obtain this loan, but has arranged the credit agreements just in case a need exists for additional funds. Such creditor agreements do not represent a liability unless the firm actually requests the fund. From the point of view of analysis, the existence of a substantial credit agreement is a positive condition in that it could relieve pressure on the firm if there is a problem in meeting existing liabilities. In return of giving a credit agreement, the bank or insurance company obtain a fee. The commitment fee is usually a percentage of the unused portion of the communities. Also, banks often require the firm to keep a specific sum in its bank account, referring to as a compensating balance. And the textbook exhibit 315 show credit agreements for Crowley's companies incorporated. Long-term liability relating to operational obligations, including the obligations arising from the operation for the business. Mostly the service nature, such as the patient obligations, a post-treatment benefit obligation other than patient plan, difference tax, and service warrants. Chapter 7 cover at the least patients and post-treatment benefit obligation other than patient plans. Different tax are causing by using different accounting methods for tax and reporting purpose. For example, a firm may use the accelerated depreciation for tax purpose and the streamlined depreciation for the reporting purpose. This causes tax expenses for the reporting purpose to be higher than tax payable according to the tax return. The difference, if the temporary is a situation where revenue or expense is recognized in the financial statement in a different time period than for the tax return, and will create a different tax item like asset or liability. For example, in the later years of the life of the fixed asset, straight-line depreciation will be less than the accumulated, and therefore lower net income and the tax in earlier year, but higher later the different tax revenues. If tax rates change, the increasing in the tax rate may exceed the prior year difference in tax. In this case, the particular or total reversal will not occur at the old rate. Warranty obligations are estimated obligations rising out of product warrants. Product warrants require the seller to correct any deficiencies in the quality or performance of the products or service for the specific period of time after the sale. Warranty obligations are estimated in order to recognize the obligations at the balance sheet date to change the expensive to the period of the sale. So we introduced the currently liability and non-currently liability. So we can just introduce, so we talk about something other non-current liability. So many other non-current liability may be disclosed. It will not be practical to discussions of the possibility. An example would be deferring the profits on sale. This is one type of the other non-current liabilities. But this we just talked about this part is next, so move on to the next. Thank you. Redeemable preferred stock is the subject to mandatory reductions required or has the redemption feature outside the control of the issuer. If this feature is complete with the share characteristics as a non-vote or fixed return, often preferred stock or the bond look similar. Thus, this type of preferred stock is more like a debt than equity. So, for this reason, SEC direct three categories of the stock. The first is the redeemable preferred stock. Second, non-redeemable preferred stock, and the third, common stock. These three types of stock not to be totally in the balance sheet. Therefore, the stockholders' equity section should not include redeemable preferred stock. Redeemable preferred stock, which is considered as the part of the total liabilities for the purpose of financial statement analysis. Non-controlling interest inflects the ownership of the non-controlling shareholder in the equity of the consolidated subsidiaries less than whole owns. Consider as follows simple example. The partner P owns 90% of the common stock of the subsite S. Period of the new standards took effect for the fiscal years and the beginning after December 15 in 2008. Non-controlling interest is the called military interest and was usually presented after liability and before shareholders' equity. With the new standards, non-controlling interest is presented with the shareholders' equity. Non-controlling interest is seldom military. In a firm where non-controlling interest is military, the analysis can be performed twice. One, with non-controlling interest as a liability to be conservative, and then as a shareholder equity item. The analysis in this book will leave in the non-controlling interest as a shareholder equity items. Okay, so this is this book the methods, but if you are analysis, you maybe have the something other methods like as I said, is to be conservative. Under the new stand, reconciliations of the beginning and the ending balance of the both patent and the non-controlling interest equity amounts must be present. This including net income and the owner's contribution attribute and each of them. The presentations can be a note or in a statement of the stockholder equity. So we introduced the liability and assay. So we move on to the third phrase is about the stockholder equity. The stockholder equity is the residual ownership interest in the asset of an entity that remaining after the reduction is the liability. Usually divided into the two basic category, paying capital and retain the earnings. So other accounts may appraise with the shareholder equity as accumulated other comprehensive income, equity oriented differentiated compensation, and the employer stock ownership plan. Paying capital. Both preferred stock and the common stock may be issuing a par value stock. So some states call state value stock. The actuaries of the incorporating extinguishes the par value, deciding the dollar amount per share. Many states stipulate that the par value of issuing stock times the number of the share outstanding constitutions the legally capital. Many states also design that if organization issues stock is sold below par value, the buyer is the contingently labeled for the difference between the par value and the lower amount paid. This does not usually pose a problem because the par value has no direct relationship to market value. The selling price of the stock to avoid selling the stock below par. The par value is usually set very low in relation to the intended selling price. For example, the intended selling price may be the $25 and the par value may be $1. Common stock shares in all the stockholders' rights and represent ownership that has voting and liquidation right. Common stockholder elect the board of directors and vote on major corporate decisions. In the event of liquidation, the liquidation rights of the common stockholder give them claim to company asset after all creditors and preferred stockholders' rights have been fully forwarded. Preferred stock is different like the common stock. Preferred stock seldom has a voting right. When preferred stock doesn't have a voting rights, that's usually because of the missing dividends. For example, the preferred stockholders may receive voting rights if their dividend has been missing 2 consecutive times. Some other preferred stock category, including the follow, uh, prefers prefers as to dividends, accumulations of dividends, participation in exercise of the stated dividend rate, convertibility into common stock, callable by the corporation. Redemptions at the future maturity date. So you can see the previous discussion of redeemable preferred stock and preference in the liquidation. And we will introduce some category features later. When preferred stock has the preference as to dividends, the current year preferred dividend must be paid before the dividend can be paid to common stockholders. For par value or stated value stock, the dividend rate is usually stated as a percentage of par. For example, if the dividend rate were the 6% and the par were 100 per share, then the dividend per share would be 6. For no par stock, if the dividend rate is stated as 5, then each share should receive 5 if the dividend is paid. Performance as to dividends do not guarantee that the preferred dividend will be paid in a given year. The board of directors must decline the dividend before the dividend is paid. The lack of a fixed commitment to pay dividend and the lack of the due dates on the principal are the primary reason that many firms elect to issue preferred stock interested of bonds. Preferred stock usually represented an expensive source of fund compared to bond. The preferred stock dividend are not tax dedu- uh, deductible, whereas the interest on the bond is deductible. Accumulation of dividends. If the board of directors does not decline dividend in the particular years, holders of non-cumulative preferred stock will never be paid that dividend. To make preferred stock more attractive to the investors, a corporation particularly issues cumulative preferred stock. If the corporation failed to decline the usual dividend on the cumulative preferred stock, the amount of unpaid dividend becomes dividend in arrears. Common stockholders cannot receive dividend until the preferred dividends are paid. To illustrate the dividend in arrears, the current preferred stock dividend. Assume a corporation has preferred stock with the state dividend rate of 8%, 100 per cumulative preferred stock. If the dividend are not paid in the 2010 and 2011, but are declined in the 2012, the preferred stockholders would be entitled to the dividend in the arrears of the I'm counting this thousands, hundreds, 160,000, and the current dividend in 2012 of the 80,000 before any dividends can be paid to common stockholders. Participation in excess of the state dividend rate when preferred stock is the particularly preferred stocks may receive an extra dividend beyond the state dividend rate. In terms of the participation, uh, depends on the term included with the stock certificate. For example, the terms may state that any dividend to common stockholder of 10 per share will also be given to preferred stockholders. To illustrate participating preferred stock, assume that the corporation has 8% 100 per preferred stock. The terms of the participations are that any dividend paid on common share over 10 per share will also be paid to preferred stockholders. For the current year, the dividend of 20 per share is declined on the common stock. Therefore, a dividend of the $10 must be paid per share of the preferred stock for the current year. The 10, that means the 8% multiple 100 plus 2 is equal to 10. Convertibly into common stock convertible preferred stock contains provisions that allow the preferred stockholder at their option to convert the share to preferred stock at the specific exchange ratio into an other security of the corporation. The other security is almost always common stock. The conversation's feature is very attractive to the investor. For example, the terms may state that each share to preferred stock can be converted to 4 shares of a common stock. Convertible preferred stock is similar to the convertible bond, except that there are no fixed payout commitment with the stock as with the bond. The preferred dividend may not be declined, and the preferred stock does not have the due date. Another major reason for issuing convertible preferred stock is similar to that for issuing convertible bonds. If the price of the common stock is low, in the option of the management and the firm desire to increase its common equity, then the firm can raise in more money for the given numbers of common share by first issuing convertible preferred stock. A firm usually prefer to issue convertible bonds rather than convertible preferred stock if its capital structure can carry more debt without taking on too much risk. The interest on the convertible bond is tax deductible, while the dividend on the preferred stock is not. The capability by the corporation. Callable preferred stock may be retired or recalled by the corporation at its option. The call price is part of the original stock contract, with the preferred stock is also cumulative. The call terms normally require payment of dividend to arrears before the call is executed. The call provisions favor the company because the company decides when to call. Investors do not like a call provision. Therefore, to make a security that has a call provision marketable, the call provisions can normally not be exercised for a given number of years. For example, callable preferred stock issuing in the 2011 and have a provision that a call option cannot be exercised prior to the 2021. Preference in the liquidations. Should the corporate liquidate, then the preferred stockholder normally have the priority over common stockholders for the settlement of claim. However, the claim of the preferred stockers are the secondary to the claim of the creditor, including bondholders. Preference in the liquidations for the preferred stock over common stock is not usually considered to be an important provision. This is because often in liquidations, funds are not uh, sufficient to pay claim of preferred stock. Even creditors may receive only few cents on the dollar in the certification of their claim. Disclosure. Preferred stock may carry various combinations of the provisions. The provisions of each preferred stock issuance should be disclosed either the practical in the stockholder equity sections of the balance sheet or in a note. A company may have various preferred stock issue, each with different provision. Donated capital may be included in the paying capital. Capital is donated to the company by stockholders, creditors, or other parties, such as a city. For example, a city may offer land to company as an investment to locate a factory there to increase their level of employment. The firm record the donated land at the appraising amount the records and amount as donate capital in stockholder equity. Another example would be a company that needs to increase its variable cash. A plan is the deposit calling for the existing common stockholder to donate a percentage of their stock to company. When a stock is sold, the proceeds are added to the cash accounted and the donated capital in stockholders' equity is increased. Retired earnings, they are the undistributed earnings of the corporation. That is the net income for all past period minus the dividends, both cash and stock, that have been declared. Retired earnings, cash dividend, and stock dividend are reviewed in more detail in the chapter 4. And if you have a textbook, exhibit 319, illusion the presentation of the retired earning. Okay, starting from this page, we need to introduce something other of the basic elemental of the balance sheet, because we finish about the asset, liability, and equity, but we need to introduce something other very important things. So the quasi-reorganization is part 1 of the important things. Okay, the quasi-reorganization is accounting procedures equivalent to an accounting fresh start. A company with the deficit balance in retired earnings start over with a zero balance rather than a deficit. A quasi-reorganization involves the reclassification of the deficit in retired earnings. It removes the deficit and an equal amount from pay-in capital. A quasi reorganization may include the restatement of the carrying value of the asset and the liabilities to reflect current value. When a quasi reorganization is performed, the rental earnings should be dated from the readjustment date and disclosed the financial statement for a period of 5 to 10 years. Conceptually, the cumulative other comprehensive income represents rental earnings from other comprehensive income. In addition to the aggregate amount, companies are required to disclose the separate category that make up accumulated other comprehensive income. The disclosure of the separate components can be made on the face of balance sheet, in the statement of the stockholder equity, or in the notes. Chapter 4 covers the comprehensive income. An employee stock ownership plan, ESOP, is a qualified stock bonus or combination stock bonus and money purchase pension plan, designed to invest primarily in the employee security. A qualified plan must satisfy certain requirements of the Internal Revenue Code. An ESOP must be a management trusted plan for the exclusive benefit of the employees. The trust that is part of the plan is exempt from the tax on its income, and the employee/sponsor get the current deductions for the contributions to the plan. The plan, particle plans, become elegant for the favor taxations of the distribution from the plan. The ESOP may borrow the funds necessary to purchase the employer's stock. These funds may not be borrowed from the company. its stockholders, or third parties such as a bank, the company can guarantee the loan to the ESOP. Financial leverage, the ability of the ESOP to borrow in order to buy employee security, is uh, inter, a very interpoled asset. From the company's perspective, an ESOP has both advantage and disadvantage. One advantage is that an ESOP serves as a source of funds for the expansion at the reasonable rate. Other possible advantage as follows. Means to buy a stock from the major stockholders or possibly an unwanted shareholders, help in financing a leveraged buyout, reduces the potential of the unfriendly takeover, help in creating a market for the company stock. Some firms do not find ESOP attractive because it can result in a significant amount of voting stock in the hands of their employer. Extinction stockholder may not find the ESOP desirable because it will uh, probably dilute their potential ownership. The employer contributions to an ESOP reduce cash and an expensive for the present time decreases stockholders' equity. The unearned compensation is amortized on the income statement in the subsequent periods. When an ESOP borrows funds and the firm in an informal or formal guarantee commits to future contributions to meet the ESOP debt service requirements. Then the firm records these communities as the liability and as a deferred compensations deduction within stockholders' equity. As the debt is liquidated, the liability and the deferred compensations are reduced. Treasury stock. A firm credits treasury stock when it repurchases its own stock and does not retire it. Since treasury stock lowers the stock outstanding, it is the subtracted from the stockholders' equity. Treasury stock is, in sense, the reduction in the paying capital. A firm may record treasury stock in two ways. One may record the treasury stock at par or state value, referred to as the par value method of the recording treasury stock. This method removes the paying capital in exercise of par or state values from the original issue. The treasury stock appraised as the reduction of the paying capital. The other method, referred to as the cost method, records the treasury stock at the cost of the stock, present as the reduction of the stockholder equity. Most firms record the treasury stock at cost method. Note that the firm can record gain or loss from the dealing in its own stock. Any apportionment gains or losses related to treasury stock must impact stockholder equity, such as reduction in the retained earning. Firms are required to present reconciliations of the beginning and the balance of their stockholders' account. This is accomplished by the presenting a statement of the stockholder equity. This statement will include all of the changes in the stockholders' equity account. It is important when performing exercise to be aware of these changes over time. For example, common stock will indicate the change in common stock. Rentality will indicate change in the rentality. Treasury stock also will indicate change in the treasury stock. This statement is illustrated in chapter 4. For many firms, it is important to observe the change to account occurrences the other comprehensive income. This account is related to you can find the more detail in the chapter 4. The balance sheet have some limitations, so if we just try to make a financial decision based on the balance sheet, so we have got some problem. So the problem of that? Numerous problem inherent in balance sheet presentations may cause difficult to analyze. So first, many assets are carried at a historical cost, so one can determine the market value or replacement cost from the balance sheet and should not assume recorded amount appreciate current value. This is the first problem. Second, different valuation methods are used. Inventories may be valued differently from firm to firm and within the firm. By product, similar issue arising for the long-term assay and their related reserve. Another problem is the asset classification. Uh, Certain valuable items, like such as the good employee relations, effective management, prime location, do not operate as assay on the balance sheet. Likewise, liability related to the contingency also may not appear on the balance sheet. Chapter 6 and 7 present many of the problem of the balance sheet. This is problem do not make statement analysis impossible. They mightily require that qualitative judgment be applied to quantitative data in order to assess the impact of this problem array. IFRS do not require a standard format for the balance sheet. Usually, non-current assets are presented first, followed by the current asset. For liability and owner's equity, capital and the receivables, and the usual list first. Then, non-current liability and the last current liabilities. The receiver sections of the capital and the receivers will not be part of US GAAP. Reverses may result from the upward revaluation of the properties and investment. Adjustments may also result from currency translation difference, similar to the US GAAP classification of the other comprehensive income. The IFRS also has some limited, like uh, the model financial statement of International GAAP O's Limited for the year ended 31 December 2011 are intended to illustrate the presentation and disclosure requirements of the International Financial Report Standard. They also contain additional disclosures that are considered to be the best practice, particularly where such disclosure are included in illustrative example provide with a specific stand. In addition, the model financial statement has been prepared without regard to local laws or regulations. Preparers of the financial statements will need to ensure that the options selected under IFRS do not conflict with the such source of the regulation, uh, such as the revelation of essay is not permitted in certain regulations. But these financial statements illustrate the presentation and the disclosure required when an entity adopts the remunerations model on the IAS 60 protected plant and equipment. In addition, local laws or security regulations may specify disclosure in the additional to those required by the IFRS, like in relation to the director's remuneration. Preparers of the financial statements will consequentially need to adopt the model financial statement to complete with such additional local requirements. The model financial statement do not include in separate financial statement for the parent, which may be required by local laws or regulations or may be prepared voluntarily, where an entity presents a consolidated financial statement that's complete with IFRS. The requirement of IAS 27 consolidate and separate financial statement as amounted will apply. Separate statements of the comprehensive income, financial position, and the cash flow for the parents will generally be required, together with supporting notes. Suggested disclosures are cross-reference to the remnant requirement of the standard and interpretations. For the purpose of the presenting the statement of comprehensive income and cash flow, the alternative allowed under IFRS for those statements has been illustrated. Preparers should select the alternative most appropriate to their outcome statements and apply the chosen presentation method constantly. Note, in this model financial statement, we have frequently included line item for the which nil amount is shown, so as to illustrate item that, although not applicable to international GAAP holders limited, are community and counted in practice. This does not mean that we have illustrated all possible disclosure. Neither should it be taken to mean that, in practicals, entities are required to display line item for such nearly amount. This financial statement, if you have a textbook, you can find more detail in the exhibit 323. This is the exhibit 323. You can find it on your slide, and I also presentations about this video. Notice that you can just reviewed it about every item, ISA items, and then the notes, and then every numbers. You can just calculate it to make sure to revise and verify it that these numbers. So that would be the very nice example for the IFRS model consolidated balance sheet. Subsequent event occurring during the time period between the balance sheet date and the debt statement are issued. There are two types of the subsequent events on the GAAP. Those that require retroactive recognition. These require balance sheet and income statement recognition. And those that do not require retroactive recognition but require disclosure in the notes to the financial statement. Both types of the subsequent event should be mandatory. Subsequent events that require retroactive recognitions usually related to estimates that were made, and subsequent even indicate that the estimated were substantially incorrect. Possibly, a major customer has gone bankrupt and a reasonable amount was not provided for in the allowance for doubtful account. The second type of the subsequent event does not affect of the balance sheet date, but does appear to be significant to the users of the financial statement. Possibly the CEO has died and the company is searching for a new CEO. Another example would be the issuance of the significant amount of the common stock. So we don't have the summarize in this video, and so we just will just end this video for the end audience. Thank you so much, and don't forget the count. Don't forget your homework or online quiz or the discussions comment. Thank you, everyone. Bye.